Hey everyone, welcome back to the channel. Dean here, and I'm back for another video where we break down what's really happening in Toronto's commercial and industrial real estate market. Toronto's industrial market is shifting, but not in the way you might think. Despite economic uncertainty and slower leasing activity, the central GTA continues to hold strong as one of the most in-demand areas for investors and business owners. So, what's really happening in Toronto's industrial scene, and what does it mean for you? Let's break it down. In Q3 2025, the Toronto Central Market, which includes Scarborough, North York, and Etobicoke, saw some subtle but important shifts. The overall availability rate ticked up slightly to 3.8%, while new construction slowed with just over 182,000 square feet underway. Absorption dipped into the negative, meaning there's a bit more space on the market, and average asking rents softened to $16 per square foot. But here's the interesting part: sale prices actually went up, reaching $400 per square foot, showing that investors are still betting on the long-term strength of the central market. So, why is the central Toronto market still so attractive even with slower leasing? It comes down to location, labor, and logistics. These areas are closer to the downtown core, connected to major highways, and benefit from strong public transit and a large workforce. For investors, this means lower transportation costs, better accessibility, and consistent demand, even when the economy cools down. And for business owners, being in the central market provides an edge in operations, delivery times, and employee access, things that 905 regions simply can't always match. Now, let's take a closer look at what's happening across the three major submarkets. Scarborough recorded 12 new leases totaling 650,000 square feet, with rents ranging from $10 to nearly $20 per square foot. Investors also snapped up a few mid-sized industrial sites for around $217 per square foot. North York saw 5 property sales averaging $268 per square foot, while rental rates averaged around $14.73. The area remains a magnet for distribution and last-mile logistics operators. And last, but definitely not the least, in Etobicoke there were 10 leases totaling over 728,000 square feet, with sale prices averaging $317 per square foot. Etobicoke continues to lead with modern inventory and excellent highway connectivity, one of the key factors driving tenant demand. So what can we expect heading into Q4 and beyond? Rental rates will likely continue adjusting, especially for Class B and C buildings, as businesses become more selective and landlords offer more flexible terms. Property values may soften for some investment assets, but owner-occupier demand remains strong, especially with limited supply and fewer listings hitting the market. And developers, they're still hunting for infill sites, those older industrial properties that can be transformed into modern logistics hubs or industrial condos. In other words, while the market is rebalancing, opportunity hasn't disappeared, it's just changing shape. The takeaway? Toronto's central industrial markets are recalibrating, not retreating. If you're a landlord, investor, or business owner, now's the perfect time to reassess your property's value, review your lease strategy, or position yourself for the next growth cycle. Remember, while others pause, those who plan ahead often come out ahead. That's a wrap for our Q3 market update. If you found this helpful, don't forget to like, subscribe, and share this video with someone in your network who could benefit. Feel free to comment down what you want us to discuss next. If you'd like a confidential property assessment or want to know what your building could sell or lease for in today's market, my team at GTA Commercial Brokers is here to help. Thanks for tuning in, and I'll see you in the next one.